Well, hello everyone. I am so geeking out about today. I've talked a little on this podcast about buying my first house. Gosh, it was a year and a half ago now, which is crazy. And what I haven't said is that while I was doing it, I was so nervous and I was confused and it was all ridiculous. And I watched every single TikTok that today's guest has ever made like four times, and it did everything from help like educate me on the process to also make me feel really good about myself because she does these like skits with these stories of really like the worst home buyers ever, and I would just be like, at least I'm not like that. I don't think my mortgage officer hates me, and it made me feel so much better. So I am so thrilled to have the brilliant and hilarious Jordan Nutter on today to talk to us a little bit about buying homes. Hello, Jordan. Thank you so much for being here.
Thank you for that introduction. I love that. That was wonderful. And congrats on purchasing. How's having being a homeowner?
I love it so much. I got very fortunate that I had an amazing realtor who had, I'm not kidding, like three or four inspectors look at the house. She was
Wonderful.
amazing. And like my uncle came and like inspected everything. So I actually got a house that I've been through all sorts of weather, and I'm so far, knock on all the wood, I haven't had any major problems. I'm
Wonderful.
Which has been wonderful. And I love my house. I love coming. I was just on vacation for 2 weeks. I had an amazing vacation, but I was so excited to just come home to my little house.
I love
So
that. I
it's
love that.
it's been amazing, and also a surprising amount of security that I didn't expect. Uh,
Okay.
in owning a home, and we'll talk a little bit sort of like I moved and all these things, but I've
Yeah.
just been wonderful.
I love that. Well, congrats. That's wonderful. And that's a good, I'm very familiar with that feeling. It's a very good feeling to have.
Yeah, it is. So before we get started, tell everyone all about you.
Yeah. So, um, I mean, we could be here forever. So I'll give you just the cliff notes. I started in mortgage back in 2019, right before COVID hit. And I'm fortunate in my world, I was fortunate that COVID hit because it allowed me because we couldn't go anywhere. I really was able to like dive in, marry my job really, because I knew nothing about mortgages when I got into the industry. And I also moved from California to Georgia to do it. So I knew no agents,
Oh wow.
nobody here, knew nothing about mortgages. And I was like, how am I going to get people to want to work with me? So it allowed me to like sit and not go out and read the guidelines and listen to people talk on the phone and just figure out how to be a good loan officer and find my footing in this. So I'm really fortunate that time happened for me. And since then, I've been even more fortunate to now have licenses across multiple states. I work with a company that we service everywhere in the United States except for New York. So it has helped me a lot to be able to help individuals that follow me like you that reach out and they're like, hey, we really need help and we want you to help us, whether it's you or you and your team. And so that's been really wonderful. And I do social media. Like I educate. I wholeheartedly believe in social media. It has completely changed my life. It's changed my career, and I've been able to fully help educate first-time homebuyers. And even I have people that aren't even first-time homebuyers that haven't bought in years, and they don't, the process is very different from the last time they purchased, and they still come to me from social media. So I've been very fortunate to grow a nice following and have some really wonderful followers and really a community online that has supported me and continues to show up. And I appreciate so much. So yeah, that's what I've been able to do. And it's been great. And we keep educating. And now I'm helping agents educate their clients in their niche markets. And that's been really wonderful to help see other people really thrive on social media and
Yeah.
reach out to people that truly need it.
Yeah, I mean, it's interesting because I am an aging millennial, so I of course didn't discover TikTok till halfway through lockdown, and now I no longer have it on my phone because I need to read books again. But when I was on TikTok all the time, there were some people, and you were certainly one of them, who I was like, oh, they've figured out how to use this platform in a way that is really educational and useful for their audience, that is clearly building your business. And I mean, even like my mortgage officer, and probably a lot, should be thanking you, because I got a lot of things not to do from watching your videos that made her life a lot easier. And so I've found it interesting and really inspirational. And I've lately been thinking about, like, could I use social media better? And it's like, there are people like you have really figured out the secret to, like, how to use it to help really all of the stakeholders.
Yeah, 100%. Because I mean, I have agents that reach out to me. I have loan officers that reach out to me, and they're like, thank you so much for putting this out there. Like, we need more education, or you've like built my confidence to want to try social media and help educate my area that I service. Or just home buyers in general, whether they use me or not. Like, I have multiple clients that reach out to me, and they're like, I had to go with new construction, or I wanted to go in new construction and I had to go with their lender. I couldn't use you. But if it wasn't for you, like, this process would have been horrible, because that lender they didn't explain anything to me. They didn't help me. Like, they just sent me the paperwork and called it a day. And so, I'm fortunate enough to be able to put the content out there, and it helps people in places that I don't even realize, which really makes me happy. It fills my cup, because my goal at the end of the day is to help as many people as I possibly can. And if they work with me directly, great. And if not, then at least I was able to help them in some capacity to make homeownership, a dream of theirs actually to come to fruition. So it really does, when people are like, oh, you're an influencer. And I'm like, I'm not an influencer. I'm a content creator, and I educate. Like, I full blown, I'm not, I mean, if you look at my feed, there's maybe, out of the 4 years almost that I've created content, there's maybe a dozen dancing videos. Like, they're very far and few between. They're not really there. Like, I'm full on talking head trying to educate, or the skits, which
are very educational themselves.
And that also, yes, there is an education piece behind it, because there's always somebody on the other line who's doing something they shouldn't be doing. And there's always a lesson to be taught within that. Some of them are a little obnoxious, but
they help. That your skits made me so paranoid about using a credit card. I didn't even want to look at a couch. Like, I
didn't even want to look at one.
Paranoid about not making any of those mistakes, because
you need to, like, there's and this is the thing. Some of the, I'm fortunate now that most of the people that come to me from social media have followed me long enough to know, like, the do's and the don'ts. So it's harder for me to get the content. I have to ask, like, other people on my team for help, and what are they currently going through. But if you just think about it, like, you go to the store and you're checking out at Ulta or TJ Maxx, or I'm trying to think another place that, like, tries to tell you about a credit card, Old Navy. Like, they're like, hey, do you want to save 20% today? And they show you their screen, and they're like, oh, you'd save X amount of dollars, and you'd think nothing of it. And then you're in the middle of buying a home. You can't do that. I mean, I tell people you can't do that, because you really should not. And most of the time, my borrowers don't max out the amount they can qualify for. But those people that do max out the amount they qualify for and then open up a credit card, I'm like, now we got to pay the credit card off, and we got to redo the credit, and we got to make sure this is taken care of. And it's just like a whole extra layer that didn't need to be added to the transaction.
Yeah. So let's start, for all the listeners who are right now like, this sounds great, but I don't even understand what a mortgage is or how it works. Let's do mortgages 101. What is it? How do they work? Why do we do them?
So, if you are looking to purchase a home, now this is going to be because I specialize in residential property. So, something with commercial, you're going to have to talk to somebody else about that, unfortunately. That's not my area of expertise. But when it comes to buying a home, whether that's a single family home, a condo, a townhome, you want to buy a duplex, anything that where you can live in it, an investment property, a second home, whatever the case is. And you don't have the cash and liquidity to purchase it outright. You need to, just like when you get a car, you have to get a loan for it. So that's where I come into play. And so when you look at getting a mortgage, traditionally, I would say 99% of the clients that I work with get a 30-year fixed rate mortgage. That's the longest term. It's the safest one. Your rate isn't fluctuating. It's fixed for the entire term unless you refinance it. And you are getting a loan against the property that you're trying to purchase. Now, some of them require no money down, like VA loans. You don't have to put anything down. USDA loans, you don't have to put anything down. And then there's other options that have very, very low down payments, like 3%, 3.5%. So traditionally, you do have to come out of pocket some sort of money for a down payment. And then we as the lender come up with the rest to purchase said home on your behalf. And then what happens is we essentially hold the mortgage for it. We hold the paper for it. 30 years down the line, or if you pay it off sooner, you get that paper in hand. So you truly own the home outright, just like title from a car when you pay it off. So the process can be pretty straightforward. It can be super easy. It can also be really difficult if you're working with people that don't fully understand your scenario, what you're hoping to achieve with it, if you're wanting any sort of down payment assistance. So traditionally I tell people, hey, if you're wanting to purchase a home, it is never too early. I have people that reach out, they're 2 years away. They're like, listen, I'm in school still. I'm not looking to buy a house right now, but I want to make sure I'm not doing anything right now that would potentially hurt me in the future. So it's never too early to reach out to somebody just to get some basic questions answered about your credit and about your income, because there are a lot of moving pieces to it. But again, if you have somebody who's educated and knows what they're talking about, it makes your life as the consumer substantially easier throughout. So you just reach out and have that conversation. And generally I say when you're about 60 to 90 days out from ready to fully start moving, is when you should talk to a lender and have that conversation if you haven't beforehand, and at least do a soft credit pool and put an application together to make sure, hey, my expectations are realistic. Because if you're trying to buy, a $500,000 home and you're trying to have a $2,000 a month payment, those two aren't really going to align unless you have a crazy amount of down payment.
Yeah.
And so you want to make sure that you understand, what does that equate to? What I'm looking for in my area, does it equate to my monthly budget? And if not, is there a way to get there, or do I have to adjust my expectations when it comes to purchasing?
Yeah. So what particular considerations or challenges do people who are single face when they are looking to buy a home?
So traditionally, my single buyers tend to also be first-time home buyers, and they tend to be a little bit younger and have student loans. And that's
some of us are old and have student loans.
We're not old. But student loans is generally the bigger one that I fall upon. And most people are like, oh, well, they're in deferment. I don't make a payment. I can't use a zero payment. It's just not how it works, because they're going to be due at some point. So I have to account for that as part of your debt. And, the guidelines can change throughout the years, but as of right now, they all require a payment. Now, whether that's you being on a payment plan, and I hate to tell you, if you're on a payment plan and it says $0 a month, we can't use it.
Yeah.
So depending on the loan program, we have to count a certain percentage against your monthly debt. And really the only way around that is if you have a letter that states these were forgiven, and they just haven't, come off the credit yet. So that tends to be the biggest one. And also affordability, depending on the area. My Georgia clients, my single Georgia clients can generally purchase a home without an issue.
Yeah.
But places like Chicago or Dallas, those are much harder because the property tax rate is substantially higher in places like Illinois and Texas. They tend to run around 2 to 2.2%, whereas places like Georgia are like 0.75 or 1%. So that tends to be a big contributor as well, depending on where they live.
It is. And I want to talk more about that because that was also a huge factor in why I was able to buy a house. But before we get there, what are the pros and cons to buying a house anyways? What are the things people should be thinking about if they are considering whether it's the right choice for them in the first place?
Yeah. So the biggest misconception, and there's probably going to be somebody who's watching this that is not going to be happy that I say this, but there's a lot of agents primarily when they're posting on social media. It's not so much lenders because we know better than to do this, but agents will, post out there, and they're doing it, I'm sure, out of like, there's no ill will behind it. It's just the education piece where they'll put out there like, you're paying your somebody else's mortgage when you're renting, which is true. And that goes up every year, which, may or may not be true. With a mortgage, you're set for the entire time. Your payment is always that way. And I'm like, you can't say that. There's a lot more security around your payment when it comes to a mortgage, because again, especially if you get a fixed rate, fixed terms in general, but things like property taxes and homeowners insurance can adjust. If you put a claim on the home, that could hurt you. If just the value of your home rises over the years, that will adjust your property taxes. So, but there is more certainty around a mortgage payment than, a lease. So I would say the pros are you have, especially if this is with a mortgage, so you have a tax write-off because the mortgage interest that you are paying every year, that's part that you can write off on your taxes, as well as if you paid for any points, and points is kind of a whole nother topic, but points are tied to your interest rate. So if you buy down your interest rate, it's called buying discount points. So if you pay for those at closing, that's another write-off on your taxes. If you use a portion of it for your home office, that's something that you get to write off as well. So those are the pros. And having that security, having a place to grow equity over the years, and having a little bit more certainty around your payment. The cons to it are you have to take care of it, right? You can't call John, your landlord, and be like, I need to get the maintenance guy to come and change the air filters, or like the sink is leaking. Like, that's something you have to take on yourself.
Yep. And
that's why I very much advocate for making sure you get an inspection, even though as a lender, we don't require it. I wholeheartedly believe 100% that you should spend that $500 to $1,000 on an inspection, because they do a deep dive and you want to make sure. And I don't want to sit here and say they catch every little thing, but if you have a good inspector, they'll point out the things that you need to take a look at and get sorted out before you take on that home. So that's the cons to it. And depending on if you get assistance or not, you would be coming out a larger chunk of money potentially than you would to go into a lease. Lease, you have 1 month and maybe security deposit. Buying a home, if you don't get any sort of assistance and no seller help, which isn't very likely these days. I mean, a lot of people are getting that. You would have to have some money saved or a gift, or you have to pull from a 401k, something along those lines.
Yeah. And it's interesting. First of all, I will say to anybody listening, pay for the inspector and be sure you get a good inspector, because there are inspectors that will sort of just like smile and nod, and then they're like, get a very good one. That was hugely helpful for me. And then we were able to negotiate down the cost of the house based on some of the stuff he found. So it made a huge difference. But so, you know, I'm glad we went through that, because one of the things that obviously is a huge problem everywhere in the world, but particularly in this country, is that there are many parts of the country where it's wildly expensive to buy a house. I lived in Los Angeles. So similarly, I moved from California. And there's no way I could have ever bought a house in LA ever.
No, there's clients of mine that are like, I want to buy in LA. And I'm like, no, you don't.
No,
I couldn't afford $2,000 a month rent payment. Right. Like you can't have that same payment. You're
no
like,
way. Yep.
Your whole cost of living would be upside down. Like you would just not be happy.
No. And you just, you know, starter homes. I had a friend, she and her husband, and they had a new baby, and they bought a 2-bedroom, 900 square foot house for $1.1 million. And it's just like, even if I had that money, I couldn't do it. But I had to move to rural Arizona to help take care of my grandmother, who's 94. And I'm so lucky I was able to do that. But it was when I moved and I was going to get an apartment, and I was like, rent's really cheap here. And I was like, wait, how much are houses? And I was like, oh my God, houses are practically free. And I realized why people are hating Californians move places, because I was like, this is so cheap. I'll take all the houses in town.
All the houses. You got a house. You get a house.
I'm going to get a house. And then, and so then I was able to buy a house, and at far less than what my sort of calculus was that I could afford. And my mortgage is half of my rent in LA. And that's where I really say, you know, for me, that security of knowing if everything went wrong, I could work double shifts at Target and drive Uber at night and still pay my mortgage, right? Like it is, right. It's affordable enough, particularly because I am fortunate that, you know, I have a dog to pay for, and he's not cheap and won't get a job. But right, like I don't have kids, I don't have other things that my money is going to. And so this house, like I'm keeping this house forever. And if I leave, you know, rural Arizona and I go other places, then I will rent it or whatever. But like it is a place where I know, you know, my owner's insurance could go crazy. Also, I'm in a really rural small town, so my property taxes are nothing. They're hilarious, right? And so like it is an amount of security that, particularly as a single woman, I know how important that is, because I know that I'm the only person I can depend on. So if something goes terribly wrong, like when I was in LA, you know, I work with unhoused people, and there's so many people who the reason they're unhoused in LA and in big cities is because their rent was raised $3,000 overnight. And then they couldn't move because you need $7,000 to be able to move in somewhere, which nobody has. And then all of a sudden they find themselves living in their car on the streets. And that's a really real thing that happens. And I know now, no matter where I am, well, I could come back here. And so when I'm talking to people, you know, there is this really prevailing idea, and it's true, you're right, that well, millennials and Gen Z will never own houses, but really it's, well, millennials and Gen Z will never own houses in the places where we mostly live, right? Like you're never going to own a house in New York or LA, but you could move to rural Georgia or rural Arizona or something like that. And there are tons of houses that are 4-bedroom houses that cost $200,000 that you could afford. But that's a huge lifestyle change. And I'm lucky that I work remotely, right? Because I'm in a small town where I couldn't ever find a job that pays me what I make, et cetera. So when you're talking to people, when you're looking at these considerations, and even just seeing, because I'm sure given TikTok that you just get tons of comments that are like, who can buy a house in this economy? This is only for rich people, et cetera. What are your thoughts, and what do you tell people about making that calculation of, you know, yeah, maybe you have to move somewhere less expensive, and is that worth it for you?
So couple ways we look at that. I'll give you an example. I had one client in LA who her rent was like $2,200 a month, and she had the funds to put 20% down, not, you know, on anything. But again, the cost of living was going to accelerate exponentially to where she'd have to change her lifestyle, and she just wasn't willing to do that. And I don't blame her. And I said, have you ever thought of staying where you are rent-wise, and you're locked into this because there's the Um, oh my gosh, why can't I think of what it's called? She's grandfathered in to her lease, like the
She
amount
has
that
rent control.
yeah, she had rent control. So he was grandfathered in. She was good. And I said, you have the funds. Why don't we buy an investment property?
Mm.
And whether that's still in California, we looked somewhere else. And we ended up looking in Big Bear, which isn't, for those of you on here that aren't familiar, it's not that far from where she was in Santa Monica. And so she was like, I can easily Airbnb this out. She had an agent who was very familiar with the market over there, did the cost analysis, figured it out. And I'm like, now you have a tax write-off. You're putting the funds into a property like you wanted to. So you own something. It's just not where you live. And that's okay. There's nothing wrong with that. I'm not sitting here. I'm not one of those loan officers that's like, you have to own a house. Like there's no other option. No, of course not. Like everybody's situation is different. So in that scenario, it was more so she had the funds. Let's look at buying an investment property. For individuals that maybe don't have quite that much money or don't want to take that on of like, oh, let me buy an investment property somewhere else and like worry about taking that liability on, and it feels a little scary. The thought of moving is, hey, can we stay in your area? For Atlanta, for example, where I'm at? I'm not in the city, I'm out in the suburbs. But, if you're in Atlanta renting, what does that look, is your lifestyle going to allow you to move out to the suburbs a little bit? Are you single? Do you not have any kids? Like, what does that look like for you? Because if it's possible, let's move you out a little bit and allows you to buy something. And if it doesn't change your lifestyle by enough to be a concern of yours, let's potentially look at that. Like get with an agent that will show you the areas that kind of fit with what you're currently living in. It's just not necessarily in the city. So it's just those conversations of truly understanding the client's needs and what are they hoping to achieve with it, because sometimes it's not possible. Like the Los Angeles individual, we can't physically make this happen with what you were hoping to get and still stay anywhere near $2,000 a month. So, but she was willing to look at other opportunities and get an investment property at the end of the day. And other people were able to move out a little bit into the suburbs and make that possible. And over as time goes on, if you're in the home long enough and you're building that equity, that's your starter home. You move up and you keep going from there, because as time goes on, as we get older, the thought of maybe having a family or finding a spouse or not being directly in the city kind of makes it to where, hey, we're probably going to start making those moves as time go on anyways. Like, is it really that hard for me to make that adjustment now? And sometimes it is, and it's just not worth it to some individuals. So yeah, it's just a matter of truly understanding what their goals are, both today when acquiring a home and what they're hoping to achieve in the future personally, so we can see if the house would line up with it.
Yeah. I mean, I think that makes a lot of sense. And one of the things that we talk about a lot on this podcast is the huge financial gap for singles, and particularly single women, and all of the penalties around, we already don't have equal pay, and if we don't have children, we don't get child tax credits, we pay more in taxes, etc. And my accountant had for a long time been saying, you need to buy something because you're paying a crazy amount of money in taxes. You need to have these write-offs. But I was like, well, I live in LA. And it hadn't occurred to me for a while to maybe buy an investment property. And I actually looked at Big Bear too, but then the Arizona move happened. And so I think that for folks who are dealing with that single pay gap, but also don't want to move, or maybe can't because their job is in, Manhattan or Chicago or whatever, it is a really, really smart move to think about, okay, well, maybe you don't like Airbnb. For folks who don't know, Big Bear, it's where there's, it's a big skiing destination. So it's a popular Airbnb place because it's a vacation spot. But if you don't want to get have an Airbnb, you can rent it, and you can even rent it at a reasonable rent right? And have affordable housing, and you're still doing yourself a huge favor.
Right.
So, there are ways to do it that fit whatever your ideal situation is, while still helping you deal with that fact that as single women, particularly, we do have to think differently about how we're looking at our finances.
100%. And I also, because this kind of gets forgotten, unfortunately, and in some markets it feels almost impossible, like the LA's. But house hacking, where you buy a duplex, a triplex, a quadplex, and you live in one of the units as your primary residence, and you rent out the other 1 to 3 units, and you get that income. And that's passive income coming in every month. And yeah, maybe you don't Airbnb them out. Maybe they're long-term renters or whatever the case is. But anyone that's looking into building a portfolio and is kind of wanting to just get their toes wet, that's the easiest way to do it. A simple duplex, because you're there on site. You reach out to local people, local agents and investors, and figure out who are their handymen, who the plumber, the HVAC, like who are these people that you are always have on call, and have them in your Rolodex to be able to reach out to. And again, you're there on site, and you only have to live in the home for a year as your primary. So if you live in one side and you're just there to like fulfill the guideline, and you're there to kind of understand how the investment world works and being a landlord, and then you're like, hey, I want to go ahead and I've acquired enough assets now at this point, because I had the other side renting, I can go buy another house now and put 5% down, and now just rent this side out. And now you have a full investment property where you only put 3.5% if you got an FHA loan, or 0% if you're VA, or 5% if you're going conventional. So it allows you to get into investing at a substantially lower amount from your liquidity. And again, if you're able to get any sort of seller concessions to help offset that even more, I mean, there's people that we get into duplexes where it's insane. I'm like, man, I wish I could go live in a duplex right now. I could go buy a duplex. I'm like, is there anybody I know that I could get to go buy a duplex and live there? Like, I want to see this happen. It's just insane. So it's definitely possible. It's just with anything else, right? It's like whatever's out there in the media where, oh, rates went up, or, people aren't buying, or the cost. And I'm not saying that's not true. 100%. I'm not saying that's not true, but it doesn't mean it's impossible. So just because they're out there saying the rates have gone up this week, or mortgage applications are lower this week, or whatever, they're putting out there that feels a little scary and a little uncertain, 100%. I get that. But I mean, we have somebody closing last week. We closed them last week with down payment assistance and seller help, and they're getting a check back at closing.
Oh, wow.
And I say that as in you cannot make money off the transaction. So these people put their earnest money down, which is the initial deposit. For those of you that don't know, you have to put an initial deposit down to secure the home, and you get credited towards, it gets deducted from your total cash to close. But in this instance, because of the down payment assistance and the amount that the seller was contributing, we were able to get them a check back. It was not quite as much as they put in for the earnest money, but I mean, they got a check back at closing. So you can't really complain. It's definitely possible. It's just, again, getting in front of somebody who knows what they're talking about and is willing to help you. Because there's a lot of people, unfortunately, that are out there that are like, oh, you're not like an easy file. I mean, they may not take the phone call, or they may like take the phone call and answer a couple questions and then never follow up, or not give them any sort of guidance. And that's when I have clients that reach out to me and they're like, I just need they didn't really, I don't know what to do. Like, I asked them for help. They didn't really help me. I don't know what to do, what my next steps are. Will you please just I'm like 100%. And if they use me in a year, they use me in a year. If they don't, I mean, it took 10 minutes out of my day to help somebody. That's I'd rather do that than not.
Well, that is what makes you different. But let's talk about choosing a broker. How should people choose them? What questions should they ask? How can they make sure that they get a good one, other than obviously just calling you?
So yeah, 100%. I mean, like I said, we cover all of the U.S. except for New York. So I would be so honored to help, and my team would be honored to help anyone that needs it. We have a substantial amount of programs, down payment assistance. We work down to 500 credit score. So there's a lot there. But let's say you're like, hey, I want to work with somebody who's in my town. That's when I would really try to look at, this is where Facebook becomes really a great area. There's a lot of groups on Facebook that are like local real estate groups that are open to the public. You don't necessarily have to be an agent or a loan officer to be a part of it. A lot of first-time home buyer groups. So I would say look at Facebook and search real estate or home buyer, first-time home buyer, and see what comes up in your area. And start seeing who people are recommending. Because if you're seeing a lot of agents that are recommend, and even if you ask the question like, hey, as an agent, who do you trust as your lender? I would highly recommend doing that. And you'd be surprised if you see the same person or the same two people coming in over and over again by different agents. That should tell you something right there.
That's actually super smart. So let's talk about folks who are listening and they're like, I'm like 5+ years away from being ready to buy a house. What are the things that people can be doing now? And I'll say, this whole thing, the whole house buying thing happened sort of very quickly for me, but I've been doing a lot of things ahead of time that have prepped me. So one thing, I am obsessive about buying Apple stock whenever the market dips. And I have been for like over a decade. I'm always like, oh, it's a bad day in the market. I'm buying even just like 2 shares or something, right? God, I've been doing that for so long. And I've always been very obsessive about checking my credit score so that when the opportunity to buy a house became available, I had all of this Apple stock that I could sell. That was what I was able to use to help me buy my house. And my credit score was already great because I was really obsessive about it, which is hilarious because now I don't care anymore. Like, I don't have to watch credit card. I'm not buying anything. Exactly. It's like, that part of my brain has been freed up. But both of those things were things that I had been doing before I even thought buying a house would be possible. That just happened to be really helpful when I was ready to buy a house. So what are the things that people can be doing, even if right now they know it'll be a good long while before they're able to buy a house, that will help them when they're ready?
So the main things are going to be your credit, your income, and your assets, right? Those are the 3 main pillars when it comes to purchasing a home. So when it comes to credit, and this is whether you're a year out, 2 years, 5 years, it doesn't really matter. I always recommend keep the credit in your name. Like if your brother's girlfriend wants, we're not co-signing on her car. I'm sorry. You just can't do it. It's just not going to happen. I love you. I'm so sorry. I just can't. If the thought of purchasing a home is anywhere in your next 2-year time period, we're not co-signing with anyone unless they're going to be on the loan with you. We're not co-signing on debt. Because that debt, depending on how it's paid and who's on the loan and you may be fully responsible for that debt. So do your very best not to co-sign with anyone unless they are full on 100% going on the mortgage with you. That's the first thing. Second thing is your payments on your cards, your credit cards, I don't care what debt you carry, make them on time. Go on myfico.com. That's where, because you can look at your mortgage scores on there. They have a free option. They have paid options. But the MyFICO lets you look at your credit card. They let you look at your auto. They let you look at your mortgage scores. Because you'd be surprised how many people come to me and they're like, yeah, everything's good, 100%. And then I'm like, what about this Kohl's credit card? And they're like, oh my God, I forgot I had a Kohl's credit card. I'm like, oh God, I'm behind. They're like, I haven't shopped at Kohl's in years. I'm like, well, you had some like card service, maybe, I don't know. Do they charge you a annual membership fee? Something, but you're behind on it. And it completely derails the situation because you forgot you don't use the card anymore. So going somewhere and monitoring your credit, whether it's wherever. But I always say my FICO because I know they allow you to look at your mortgage scores.
Which people do not realize is different from your credit score.
100%. I know people that come from, for example, Credit Karma shows your Vantage score, not your FICO score. And in mortgage world, we use your FICO scores 5, 4, and 2. Those are your mortgage scores. They're not your FICO 8. And I know this was your people are like, what is she? You have over 30 FICO scores, which I know sounds like stupid. And to me, it's insane. I don't even understand why to this day, why there's so many. But traditionally, your bank or your credit card is going to show you your FICO 8. Most of the time, that tends to be higher. So it is important to look at your mortgage scores, at least leading up to talking to a lender, if you can. But either which way, you need to monitor your credit, avoid co-signing unless they're going on the loan with you. Keep your payments on time. Don't forget about cards that you have. And don't go out of your way to close out debt. If you don't use that credit card anymore, that Kohl's card, that's okay. If they're not charging you a membership fee, just leave it. Let it close out eventually. Don't go out of your way because we want to see that you have a portfolio. Not we as a mortgage lender, but the bureaus like to see that you have a good portfolio. So that's when it comes to credit. When it comes to income, if you're self-employed or you're thinking about being self-employed, I would rethink that if you're going to buy in the immediate future. Because I have clients that are like, oh yeah, I just quit my W-2 last year. Now I'm self-employed. I can't do anything with that. Not with traditional financing. If you want traditional financing with down payment assistance or the lowest down payment possible, you got to wait 2 years, 2 full years of tax returns. There's the loophole of you could wait a year of tax returns if you were in the same line of work previously, W-2. So there's that. But traditionally, the guideline is 2 years. So don't just go out and decide one day that you're going to go be self-employed and quit your W-2 before you buy a house.
Yeah.
So there's that, as well as considering your history. So we look at a 2-year history. It doesn't necessarily have to be at the same company. But same with self-employed. If you were salary for years and you're like, you know what, I'm going to go be a car salesman. And the next month you go apply for a mortgage, it's not happening because you went from a fixed payment every month to you, fixed income every month to you, to now this uncertain income. And yeah, you may be making more, but it fluctuates and it very easily can be super high one month, low the next month. And we don't know any sort of history that you have in that line of work. So that's another thing. If you have fluctuating income, that's going to require a history. But again, traditionally fixed salary or hourly employees, we don't need you to be at the same company, but we do need a history of work. Yeah. And a lot of people think that if they're not working that they can't qualify, but I have Social Security, disability, alimony, child support. I have a lot of people that I work with where they have income that doesn't come from a job. And most of the time we can use it. So that's a misconception that comes along. But yeah, for income and then assets, don't put that money under your mattress. Just don't. And if you do, put it in the bank right now. Go put in a high yield savings account that's getting you interest. I get that there's people out there that are scared to have their money in a bank, and for your own reasons, that's totally fine. But if you want to buy a home and you come to me and you say, hey, Jordan, I got $10,000. And I'm like, great. So it's in the bank. And they're like, no, it's in the safe at home. I'm like, we're going to have to wait because you're going to have to put that in the bank. We're going to have to wait for a while for you to buy it because they're not going to let me give you a loan when you just have this lump sum because they don't know where it came from.
Right.
It could come from an interested party and that there's no paper. I can't show that. So when it comes to assets, trying to keep them at least 90 days prior to doing an application with a loan officer, make sure your assets, if they're cash on hand, are sitting in your account. Yeah. It's something like you're getting a payout from a lawsuit or your tax return or you're getting a bonus. That's paper trail stuff. Not a big deal. We don't need that season because we can paper trail it. If we can't paper trail it.
You can't send the bank a picture of $10,000 in a shoebox.
I posted that. I didn't even have to get that off Google. So there was somebody who sent me a picture when I asked them to verify their assets. Instead of uploading their bank statement, they went into their closet and opened up a shoebox and took a picture. And I was like, I don't know what I'm supposed to do. Am I being punked right now? Is somebody going to come out of the closet and be like, haha, just kidding. Like, what?
That is hilarious.
And they came from TikTok.
Of course they did. Of
Like, what is how you walk TikTok? When people come to me and they're like, I've been watching you for years. Don't worry. It's either 100% we're good. Like I have no worries in the world, or it's the complete, there's no middleman. Like we're sending money in a shoebox, or I don't ever have to call them for anything because they get it in like 0.2 seconds to me. Like there's no in the middle. I'm either stressing out and like pacing the room, or I'm like sitting on a beach happy as a clam.
Be the beach person, listeners. So you said one thing that I wanted to be sure people are clear on. Because when we talk about debt to income ratio, you said don't close out your credit, which is one thing, but do pay down your debts. And that's a thing if you know you're prepping to buy a house in a few years, you can be spending the time ahead of that, paying off your car, your personal loan, maybe not your student loans, but whatever, but paying down your debt. So can you talk a little bit about debt to income ratio? Because I want to be sure people are clear on what we are paying off and what we're not closing.
So there's two types of credit that we carry. There's installment debt and revolving debt. So installment debt are debts that you carry that have an end period, right? So auto loans, student loans, mortgages, personal loans, anything that whenever you make your final payment, it's going to close out and you are done. The line of credit goes away and you own that asset, or you're done paying off that loan. When you close those out, traditionally your credit takes a hit. Okay. Things like credit cards are revolving, which means every month the line of credit revolves. It could be you spent $500 this month and you paid it off, and the next month you only spent $100, but it doesn't matter you paying it off. It still stays open, right? So you can pay off your credit cards all day, every day, totally fine. It's not going to hurt you. There is a misconception though, because so many people I'll go to pull their credit and they're like, oh, I have no debt. I pay my credit cards off every month. And they don't realize that there is and I know it shouldn't be this way, so don't shoot the messenger, guys. But there is a certain way that you have to pay your credit cards off to truly help your credit. So there is a due date and a statement date. So let's say, like, for example, one of my credit cards is due on the 2nd of every month, but the statement doesn't come out until the 7th. And if you don't know these dates and you're paperless, you should get the emails that say your due date and hey, your statement's now available. When it says your statement's available, that's your statement date. So if you pay off your credit card on the 2nd in this scenario, and you spend on the 3rd, the 4th, the 5th, and the 6th, when the statement comes out on the 7th, that is the balance that's going to report. Not that you paid it off on the 2nd, whatever you spent in that timeline leading up to the statement date. And again, I know it shouldn't be that way, but it is. So keep that in mind if you're trying to build your credit, to not spend, if you can avoid it, between the due date and the statement date. So that's the first thing.
That is good to know.
It's very good to know. So that's one. But yes, for installment debt, I've seen it where it does lower the credit. It brings it down 10, 15, 20 points. You pay off a mortgage, you pay off a car, whatever the case is. And so traditionally, if I have somebody who they're like, hey, my car, let's say, is going to be finished here soon, and I have the money to pay it off, and we're in the process of doing the application, we just pay it off at closing.
Mm-hmm.
We just pay it off at closing, or we pay it off after I've already pulled the credit and we know that credit's going to be good until we close. So traditionally, I don't say, I say don't go out of your way to pay any installment debt off unless you're like, a year or two out, it's going to, until you start looking. If you're trying to,
but if you're prepping, If you're
Yeah,
like 5
credit.
years from now, I want to
Okay.
buy a home.
Yeah, your credit will rebound. You know, yep, maybe a credit card here or there, that will help, but I wouldn't go out of your way
Okay. Yes.
to just pay it off if we're looking within like the next year,
Okay.
especially if you don't have a lot of credit in general.
Mhm.
So that's the one thing on there. And also to consider that we look at the debt on a monthly basis.
Mhm.
So the fact that you have $8,000 left on your car, I don't care. It's the fact that your payment's $520 a month. Sure, you pay $600 a month. Great. I want you to pay it off sooner. Pay less interest, 100%. I don't take it $600 a month. I take the $520 that's
Right.
reported on the credit. So keep in mind, everything we do is on a monthly basis. And so all of your debts, whatever is reporting, and this is why it's also important to monitor your credit, see what the monthly payment is reporting, because that's what we'll take into consideration. And also, we have to use your gross income. So if you make your salaries $100,000 a year, but you only make, 78 at the end of the day, that doesn't matter. We use your gross income because everybody's different. Like you said, some people have kids, they get less taxes. They don't, they pull. There's a number of things. Some states don't have state tax, income tax. Some do. So we use your gross monthly income when looking to qualify you. So that's the debt part. That's the income part. And if you have income that you don't report to the IRS, I'm sorry, I can't use it. Like, it's just, if you are a babysitter on the side, a nanny on the side, and you're not, I can't report it. If you have a roommate and you don't report it, I can't use it.
They start laundering that money.
So it's just one of those things. It's, I get a lot of pushback from clients that do odd jobs here and there and they get paid. And listen, I don't want to pay taxes. I hear you. Okay. Trust me. I'm the last person that wants to pay taxes, but again, don't shoot the messenger. I can't use income if it's not being reported, unfortunately. Maybe it changes one day. You never know, but I doubt it.
It seems unlikely. I think that's going to remain a requirement. So what are the top things that a home buyer can do to be the person who has you sitting on the beach and not pacing in your office? Like, how can they be a good home buyer?
Yeah. So I would say education is key. 100% education is key. So whether that means you go on YouTube or TikTok and wherever you go and you start looking at loan officers and agents that are truly passionate about what they do, and they're not just trying to put content out to sell you, but they're trying to truly give you some sort of value and educate you. Listen to them. Try to understand where they're coming from. See if you can ask questions. See if you could there's people that set up a call with me and they're like, hey, I just need this answered. I'm not really ready yet. Find somebody who's willing to answer the questions for you, and understand, what you should prepare for. Again, monitoring your credit, making sure you understand what's on there, not forgetting about that Kohl's card that you don't use anymore. And again, I'm calling out Kohl's here because that tends to be the one that most people forget about. I don't know.
Really?
They're not buying at Kohl's anymore. They forgot they had a credit card. And which is surprising because Kohl's never asked me for a credit card. Old Navy and Ulta, I'm like, nobody's forgetting about those, but they're forgetting about the Kohl's. Kohl's never offers me a credit card. So, but just monitoring your credit to make sure, hey, nobody's opening up anything, nothing's late. If you truly don't use something and it's charging you an annual fee, just close it out. At that, if you're not going to buy anytime soon, just close it out so you don't forget about it. There's no need to waste the money on it. And then when it comes to your assets, there are places like for my first home, it's actually not called, it's called something else, and I'm plugging them because I loved using them when I first bought my house. What is it called? It's called Opportune, Oportun. It used to be called something else. But what it does is it's a completely separate account, and you can link up whatever bank accounts you want. You can link however you want to do it, but it looks at your spending and it looks at your checks that come in, and it figures out like, okay, I could take like $2 today. I can take 50 cents this day. I could take $500, and so you can build out, like I built out a house one for the down payment. And then after I bought the house, I built out just like a little fund for emergencies.
Yeah.
I built out one for any repairs I would need on the house. And so you can set it like, hey, if my bank account hits $1,000 or $5,000 or whatever, like you can't pull any more money from it.
Mm-hmm.
And you could put a goal on there for a dollar amount. You could put like, hey, I need it by, June of next year. Like I do it for vacations. If I know I have a vacation in a year, I'm like, okay, I want this money saved by this time next year. And so it just monitors how you spend, and it'll pull little bits here and there. And so it was nice for a couple reasons. One, I didn't have to worry about pulling money every time. And like, it never pulled enough to where I noticed, right? It was like $2 here, $5 here. So it was like, okay, it's just pulling little bits here and there. And, over a couple years, it really does add up.
Yeah.
And so that was nice. And then out of sight, out of mind. Like I went into my bank account. I couldn't see the balance, right? Because it's a completely separate account. So that was nice because I had it on a separate page in a different folder that I never touched, and I never opened it. And it was like, every 6 months I'd go in there and be like, ooh, okay. All right, cool. Because you don't think about it, right? It's like $2 every day or $5 every day doesn't really add up, but it starts to when it's like $10, then it moves to $10 or $15 or $20. And so that one I really liked because, again, out of sight, out of mind. And it did a really good job of just like tracking what I spent, and it never pulled more than I ever felt uncomfortable. Mm-hmm. And it probably also avoided me spending that money on like coffees or, getting extra things at, going to Starbucks and getting a croissant when I really didn't need a croissant. Like it probably helped me subconsciously avoid spending extra money that I didn't need to spend.
Yeah. I love that. We've talked on this pod before about sinking funds and how important they can be. And I am the queen of having like so many things pulled out of my paycheck before I even see it that I'm always surprised at how much I actually make because I get so much less. But that is particularly when you're on a budget. Like I could not have done that when I was in my 20s. And I like the idea, especially for folks who are, again, thinking like, well, I can't buy a house now, but I'd love to in 5 years.
Right.
Like having something that's just taking a little tiny bit out so you're not really noticing it. And even if you're on a tight budget, $2 a day you could probably do, or it'll say only 50% or whatever. But like, if you don't look at that for 5 years, that could be, maybe not a 20% down payment, but a 3% that you can use with your FHA loan or something. Right. So like, I love the idea of this is a really good way to save that money, even if you are on a tight budget. Mm-hmm. And then, you'll be surprised. And if you're doing that and then doing all the other things, right, like monitoring your credit and paying down debt and whatever else, 5 years from now, you could totally be ready to buy a house.
Yeah. And there's so many programs out there, and like they come and go, right? There's some that are like they get funded and then we got to wait until the money comes back. There's other ones that just constantly stay funded. Like there's one in Georgia because when you get the funding, and whenever you sell or refinance, you have to pay it back. Mm-hmm. So that one always stays funded because the money's constantly getting circled back into the system. But there's places like Florida, Hometown Heroes, that's state funded. So once the money's gone, it's gone, and you got to wait for it to come back. Yeah. But that's a program that's been around. Georgia Dream's been around. There's a lot of state T-Shack in Texas. California, Cal HFA, like there's so many. Illinois has one, Virginia, like there's every state that I can think of off the top of my head that I personally work in has some sort of assistance. And depending on your income and your credit score, which traditionally to get any sort of down payment assistance, most of them need a 640, some a 620, and some a 660, but primarily 640 tends to be pretty common. And And some have income limits, some don't. And the ones even like in Texas that do, they're really lenient. So it's just going to be dependent on your situation, but it's worth at least doing something like that where it's like, hey, it's pulling out. Even if you don't have a lot, you, again, like you said, you'd be surprised in like 2, 3, 5 years what that adds up. And if you never look at it, you don't touch it. I mean, that could easily be a 3% or 3.5% down payment.
Yeah.
Or 20% if you're like not spending any money and you're raking in the money, it could easily be a 20% down payment.
Oh, if I could live like a nun, I'd have one of those big yachts with little spots for tiny yachts inside of it in a Lego form. No, I think that's helpful. And I think one thing that I get out of a lot of what you said today is that it is more possible for people to own a home than I think a lot of people think right now. And that we do have to be more creative, right? I did have to think like, well, I can't get one in LA, but I could get one somewhere else. And you know, right. It may take a little longer. But there are still so many different ways. And particularly when we're thinking again, since this podcast is about, you know, single and child-free people, and for single women, like that long-term security is something that we have to think about so much more. And owning a house can be that. And so even if it feels impossible, it's not. There are ways. And this is why, you know, I want to end with you telling folks all the ways they can get in touch with you, follow you, watch your hilarious TikToks, because I recommend, even if you don't think you ever want to buy a house, which is legit, I get it. My plumber charges $75 just to step over the threshold into my house. I understand. Man, we all missed the boat. We all should have been plumbers. We'd all be millionaires. But it's so helpful just to know. I mean, just understanding, because we're always hearing about interest rates and refinancing and blah, blah, blah. And it's a conversation that is being had about the larger economy. And so even if you're not thinking about having a home, watching Jordan's videos will help you understand what that conversation is about. And even if you rent, someone owns that place and your rent is going to be impacted by those conversations. And so I think it is really valuable educational material regardless. So how can folks find you?
Yeah. So all of my handles, I'm on every platform pretty much except for like Snapchat. That's one I just can't really wrap my head around. It's a Nutter Home Loan. So and then my last name, Nutter Home Loan. So again, Instagram, Facebook, TikTok, YouTube, LinkedIn. I'm on all of them. And I really do my best to push out as much education as possible, because I feel if we are able to better educate our community and our society, we will be able to do a lot more, both individually and as a whole. So that's very much my goal when it comes to creating content. And I think that the American dream is definitely not dead. It's just something where there is an adjustment, unfortunately, that has to be made. And until that is fully made somehow, some way, we have to come up with creative ways to make it possible. And if you think it's not possible, I promise you, there is some way, somehow. It may not be today, or it may be. You never know. But it may not be today, but it is something. If truly buying a home is on your radar in your life in some capacity, you won't know what you need to do to get there until you talk to somebody. So I wholeheartedly believe it's never too early. Please reach out to somebody. I would be happy to talk to you. Anybody on my team, we can talk to you and walk you through what that looks like, and at least give you what that next step would be to get into a home.
No, thank you. And I'm glad you said that, because if you turn off this podcast with anything else, leave with an idea that if you really do want to own a home someday, it is possible. And yeah, you may have to adjust some things. You may not be buying the house in Beverly Hills that you thought you were going to buy, but it is possible. And there are people, I mean, I was lucky. One thing I did too is I made sure I had a female realtor and a female mortgage broker, which meant I didn't deal with any kinds of like, oh, is your dad signing for this? Blah, blah, blah. Like there was nothing at all, because there's just two badass, very competent women, and they treated me like a normal human, and I had no issues whatsoever. And so like finding those people, finding the Jordans in your life who can help you, it is really possible to own a home, and I think worth it in a lot of ways. But being smart and thinking ahead and not buying, like, if you're qualified for $550,000, don't buy a house that's $551,000. I was like really thinking about it, but it is possible, and I want to sort of really counter the hopelessness that we see a lot of times, where people are just like, well, nobody can buy a house. You can, you really can.
Yeah, 100%.
Jordan, I can't thank you enough for joining. This was awesome. Thank you again so much. You really, really made it so much easier for me when I was going through my process, and you didn't even know me. You're helping so many people you don't even know, and I really, really thank you.
Well, I appreciate you following along and for asking me to be on here. It was wonderful. I had a great time. And again, if you need anything or anybody else on here that's watching, please feel free to reach out. It's never too early, and buying a home very much can be possible if you have the right people behind you.
We'll end it there.